Revenue, profitability, and capital are fundamental drivers of corporate performance and valuation because they determine a company's ability to generate earnings, sustain operations, and create shareholder value. The program explains that analysts evaluate these areas to assess business quality, financial strength, and long-term growth potential. Revenue reflects the company's ability to generate sales from its products or services. Profitability measures the efficiency with which those sales are converted into earnings, and capital represents the financial resources used to support operations and investment. Understanding the interaction among revenue growth, profitability, and capital allocation is essential for forecasting future performance, evaluating competitive advantages, and making informed investment decisions within global financial markets. Revenue analysis focuses on both the level and quality of sales generation. Analysts examine historical revenue trends, growth rates, product mix, pricing strategies, customer concentration, and geographic diversification to evaluate the sustainability of future sales growth. The program emphasizes that strong revenue growth alone does not guarantee financial success if growth is driven by unsustainable factors such as aggressive discounting or weak credit standards. Analysts therefore assess whether revenue growth reflects genuine market demand, competitive strength, and operational scalability. Industry conditions, economic cycles, and technological changes also influence revenue sustainability. Understanding the drivers of revenue growth helps analysts evaluate future earnings potential and identify opportunities or risks affecting long-term corporate performance. Profitability analysis evaluates how effectively a company converts revenue into earnings and cash flow. Common profitability measures include gross profit margin, operating margin, net profit margin, return on assets, and return on equity. Gross margin reflects pricing power and production efficiency, while operating margin measures the profitability of core business operations before financing and taxes. The program explains that consistent profitability often indicates operational discipline, competitive advantages, and effective cost management. Analysts compare profitability ratios across firms and historical periods to identify improving or deteriorating operational performance. Strong profitability supports reinvestment, debt repayment, dividend capacity, and long-term shareholder value creation within competitive business environments. Capital analysis examines how companies finance operations and allocate financial resources to support growth and profitability. Capital may include equity financing, retained earnings, debt financing, and internally generated cash flow. Analysts evaluate capital structure decisions carefully because excessive leverage increases financial risk, while inefficient capital allocation may reduce returns on investment. The program emphasizes that effective capital management balances growth opportunities with liquidity, solvency, and shareholder return objectives. Measures such as debt-to-equity ratio, financial leverage, and return on invested capital help analysts assess financial flexibility and capital efficiency. Companies generating strong returns on capital while maintaining manageable risk levels are generally viewed as financially stronger and more sustainable over time. The relationship between profitability and capital efficiency is especially important in evaluating long-term business quality. Companies that consistently generate high returns on invested capital often possess durable competitive advantages such as strong brands, technological leadership, economies of scale, or operational expertise. Analysts frequently use frameworks such as DuPont analysis to determine whether strong returns result from operational efficiency, asset utilization, or leverage. The program notes that high profitability driven primarily by excessive debt may be less sustainable than profitability generated through operational strength. Understanding how management allocates capital toward investments, acquisitions, research, or shareholder distributions also helps analysts assess strategic effectiveness and future value creation potential. A strong understanding of revenue, profitability, and capital is essential for financial statement analysis, valuation, and investment research. Analysts integrate quantitative measures with qualitative assessment of industry conditions, management strategy, and competitive positioning to evaluate long-term business sustainability. Revenue growth without profitability may not create shareholder value, while profitability unsupported by efficient capital management may expose companies to financial risk. The program emphasizes that successful analysis requires evaluating how these factors interact over time under varying economic conditions. By understanding the drivers of revenue generation, earnings performance, and capital allocation, analysts can forecast future results more accurately and make more informed investment, lending, and valuation decisions within global financial markets.